Alright, this is the first video of chapter 2. Chapter 2 is going to be the one where we're going through the references to price. Now remember, just to reiterate, what are we doing? We are understanding the relationship between time and price, because in any science and any sort of mathematic or science, right? Whenever there's a graph or model at hand, for you to understand what's going on, you need to take a step back and you need to understand what is the graph showing? What's the relationship of the graph? For you to know the relationship, for you to know what's going on in the graph, you have to understand the axes. The axes in any digital market for trading, it's time and price. Linking back to what I said in the Discord, you want to treat trading as close as possible to a science. I'm not the first person that said this, but it's very true, which is why I'm bringing it to your attention. You want to treat trading as close as you can to a science, because it's literally just models repeating itself again and you're trying to replicate the same outcome every single time. That's what science is. You have the scientific method, you use the scientific method to replicate results, and that's how we make money, right? Chapter 1 was going over vague market structure. When I mean vague, don't it's not bad, yeah, because I didn't touch on order blocks. I know in the weekly commentaries I touch on the order blocks and the breakers and mitigations and injections and all those type of things. When we are knee deep within this mentorship, watch the weekly commentaries from the top to the bottom, and they will make so much more sense. After this chapter, you will understand the weekly commentaries much, much more. Because in chapter 1, we were literally just talking about time, and we were talking about mainly time. Because time is fractal. We know that price is fractal because we have these time frames. But time is also fractal given the time frames as well, right? The reference points to times are on a yearly level. So the quarter of the year that we're in. Then there's the week, there's the day, the what day of the week are we in? And then there's the intraday level, which is the time of the day that we're in. That's the three main reference points to time that we care about. We've done one of them. We need to do the reference points to price before we can do the next two. And then we're gonna blend them together and it's gonna make a lot of sense. So chapter 2, what do I mean by reference point to price? Well, reference point to price just means where do we expect price to trade to and where do we expect price to react off of? There are key signatures that the market will do. This may look very confusing to one person, but it's not. Believe me, that when if I put lines everywhere showing all the reference points, all the institutional reference points, it will make a lot of sense. Sorry. I want to start this one off by showing you guys one of my personal favorite models, the mitigation block. And I'll draw what the mitigation block looks like. The mitigation block will look like this. Let me get the path out. It will look like this. Okay, that's not the path. It will look like this. This is for a bearish scenario. Just give me one sec. Call this 1. Let's call this reference point 2. Let's call this one 3. I don't want to use algebraic number, alphabet. I know some of you don't, it might not, sit well with you guys. So let's just use something all like numbers 1 to 4. Yeah. And this is 4. Perfect. So what do we see here? Yeah. And let's just put this line here. This is the mitigation. A run higher, we come down. Failure swing, yeah? Failure swing high, break down lower. When we break that low, what have I taught you guys? What is that when when we go higher and we break that low, this one, what do we call that? That's the market structure shift, right? That's the market structure shift. When you see this model happening, when you see a high, let's say you're running up higher, right? You're at a institutional support level. You run higher, you come down, retrace, and then you run higher again, but it didn't run higher than this previous high. And when you break down lower, you break this. Your attention automatically will go here. This rectangle. So when we come down from two, from from 2 to 1, people are doing what? There's buying going on. Institutions, the algorithm is pushing high prices. However, there are there are large players, institutions, because remember the algorithm, bit large players, interbank players are in line with the algorithm, right? When we talk about the hierarchy of players, people just have to talk about the big boys. Central bank. We don't get the central bank price, we get the interbank. So let's talk about the interbank. The interbank for us, they're the top, they're the top dogs. There's no one bigger than them in our market. And then you've got your large institutional players. And then within the institutions, like you got smaller institutions, like mid, low, hedge funds. And then you got large retail, like you got millionaire, billionaire retails. And then you got, your whole mid, low tier retail traders, low capital sizes. This low breaks down because the algorithm sees that it's better off seeking sell side liquidity than buy side liquidity. It breaks this low, right? When you see this, when you see this happening, when you see that this high is struggling to break, you want to sit on your hands. And when it's retracing down, you you want to see if it retraces down lower here. From 2 to 1, everyone that was buying here, they are called traders under the water. Okay? That's how I learned it. Or you can say trapped buyers. Yeah? You might hear that a lot on social media. Trapped buyers. There's trapped buyers here. So what would happen? This becomes an institutional reference point for the algorithm to free trapped institutional traders. The market comes up. It can come with anywhere within the mitigation, right? I like to have the opening and the 50%. So you wanna, within the mitigation, you wanna highlight the open and the 50. Now, what are you looking for within this mitigation? Because it's a large area. I understand. You're looking for, right? In this low, you are looking for the lowest down closed candle. That's what you're looking for. Why are you looking for the lowest down closed candle? Because think of it logically. Anything after the lowest down closed candle is going to be buying. Because if it was more selling, then that can't be the lowest down closed candle. If there was more selling after it, the one after it will be the lowest down closed candle. Do you know what I mean? We are trying to free trapped buyers. So everyone that is a trapped buyer is everyone after the lowest down close candle. Do you get what I'm saying? The lowest down close candle within this, you want to outline that. You want to outline that, and that will be your reference point that you're trying to look at. The lowest down close candle, that is the main thing that you want to look at. However, still let price breathe within here because there could be imbalance within here. There could be other important things within this mitigation area. They could be more confluence, is what we call it. Price comes up, allows them to break even, right? It allows them to break even, and price comes down. Now, price then, I don't know what I'm doing there. Let me do that again. And then when you break down lower again, it's the same thing. It's the same thing that happens. This is what you usually see this as a step ladder, or this is your wedge pattern. This is where the wedge pattern, because it could look like a wedge, right? And this is where retail could win. But they don't know why they're winning. They don't understand that they are getting in line with mitigations. They think they're getting in line with a wedge, essentially just a trend line. That's what they think that they're getting in line with. However, if the retail get lucky and are in line with the institutional reference points, they will win the trade, right? Even if a brand new trader just placed any trade and they happen to just buy off an order block. They didn't know it's an order block, they just happen to buy off of it. They'd win the trade. They don't know why they won the trade. After learning why, it will make sense. Yeah. The market will come up, lowest down close candle here, because after the lowest down close candle, everything is higher than that. And that's where the trapped buying happens. Everything above the lowest down close candle, price comes down. Now this line is where you expect to find support. So this could be running an old low, or this could be an order block, because or an imbalance. Anywhere where you expect the price to stall. And we're gonna go over order blocks and imbalance after as well. Don't worry, it's all in this chapter. But you want to trade this until you know that price will find some sort of quote unquote support where it will struggle to have some sort of struggle to trade through. This model, I think this is one of the most repetitive models you'll see ever. Now, in the Euro USD, it happens everywhere. All right, let's have a look. All right, I see it straight away. I can see it. All right, let's go here. Higher, lower, higher, lower. Price comes, trades up. Remember, all these buyers, these three candles, they're trapped buyers. They're trapped. And where did the buying start from here? The last down close candle. Yeah, the last down close candle before the move up, before the big move down. It's very different to your normal order block. I know some of you guys, this is brand new. Okay, what did the market come do? Came up within this candle and trades down lower. Comes up, trades lower, and it just happens, and it happens over and over again. Within here, now this is where you need to keep your eyes a bit peeled. So let's see this. Higher, lower. Yeah. It comes up higher and it struggles to go down. Where does your eyes go to? The lowest down close candle. This one right here. Yeah. The lowest down close candle before these two candles breaks down. Yeah. Breaks down. And then when we break this again, your eye should go lowest down close candle. Doesn't quite get there. That's fine. Now this one Look how clean it is. Comes down, buying, lowest down close candle, right? It's not this one because look, this is the lowest down close candle. There's buying here. Lowest down close candle within the low of the low, yeah? This isn't the low. This is the low. Look, high, low, yeah? Just for any confusion. Comes down. Let's see the close of this candle. Attention to this C right here. 511, 521. Just came just one pip above there. Just blame down the broker spread. Come down again. On a low time frame, it will happen here as well because we're on an hour. If you want to go down to a low time frame, same thing here. Up here, the lowest down close candle, it overshoots it. Don't get me wrong, it overshot it. The way you want to trade this would be like this though. You see the high before the drop down, your stop loss will go here above this one. So an example how I trade it is I'll wait for this, like something like this, and then the stop loss, I mean the take profit will be, so when this low happens, we're waiting for the retracement back to this candle. So just put your stop loss to this low where the retracements will happen to. Yeah, trades to it, overshoots it, it's nowhere near stopping you out, and then it's just mad choppy. And then what do we see? The reverse happens now. Now it's the reverse. We're looking at the last down close candles. Well, in the bullish scenario, you'll look at the last up close candles. So we shoot up here, come down, and then we shoot up again. You want to go to the up close candle, this one, before the move down. Yeah, overshoots it, but if you go on a 30-minute time frame, this is probably two candles, right? Overshoots it, stop loss below here, nowhere near getting tagged out. Comes down lower, shoots up again. When it shoots up and breaks the high, even this, look how clean that is. This isn't predetermined, by the way. Like, I'm for finding these examples now. Right there, this candle. And then what happens? Now, this is this is where I, this is where the majority of the teaching should be. If you go back to the left, right, remember this line. I said that's an institutional support level, and that's where you should expect the mitigations to end to. Otherwise, we'll just keep mitigating down, and you wouldn't know where the mitigation ends. When we see this happen, and we break down lower, it's all mitigation, right? Comes up, the lowest down close candle, which is this one, comes down, comes up here, comes down. That's a winning trade. At this one, we'd lose. We'd lose. This is the first loser that we would have. Again here, lowest down close candle, trades off of it, comes up. This is the imbalance that I would have waited to get traded to. After this imbalance, the last mitigation that trades into this imbalance, I would class this, right? I class this as my quote unquote support level. Why? Why would this be my institutional support level? This will be my institutional support level because it's an area of imbalance within this candle. Within this candle, there was imbalance. From this wick, just move this about. From this wick to this wick, only the body of this candle is here, right? Yes, you got an order block here as well. But this is where I would trade the mitigation to. Yes, we would all love if the market kept tanking. If we got in with this one, we would love the market to keep tanking. We would love it. But you gotta be real with yourself as well. You need to know when to get out the trade. Take your profits and run. Take your profits and run. As soon as you trade into the imbalance, that's it. Close the trade into the next one. Because you saw what happened. Now it's reversed, right? This is a market maker smart money reversal. Yes, it looks like a double bottom. However, it's at the institutional support level and it's different. Market structure shift, yeah? Now, every single time again, we can find the mitigations. We go high. What happens? We go higher. This is your mitigation right here. This candle right here is your mitigation. Because why? All these sellers here, they're trapped. All these sellers, one, two, three, four candles of trap sellers. This is the highest closed candle. Yeah. All these sellers, they're offside. The market is going to give them a chance to get out, right? This candle gets traded to perfectly, and then we break down lower. This is an imbalance fill, and now we're trading higher. You want to make sure that the mitigations are in line with your bias as well, right? So if you had a bearish bias, you'll wait for this type of pattern to form so you can get all the bearish mitigations. If you're bullish, you'll wait for the bullish mitigations like this one to form. The pinnacle to trade this model for this institutional reference point is the market structure shift. Without the market structure shift happening, you won't be able to trade this because without the market structure shift, you won't have the trapped buyers or sellers. For example, here, what do people think? People think that yeah, it's going to continue the trend down, shot up higher, making highs. This high now to stick out this high. Come to the mitigation, break higher. Fill the imbalance, take out a what? A intermediate short-term low, filled imbalance, and we're shooting up higher. Last up close candle before a move down, trap seller comes up, mitigate. Depending on your stop, you would lose this one. Again, you want to see this is a nice area to trade to. However, the time aspect is gone. This is your institutional reference point for this one, for this candle to trade off of. The last candle before the move down and then the move up. It could reject off this imbalance. However, you'd want to see where it rejects off of because it could possibly trade to this. I know there's going to be confusion around when do I take imbalance, when do I take order block, when do I take mitigation. We're going to go through that. By the end of this chapter, you will have better knowledge on what to take what. And it falls back to having logic behind every single trade and every single framework for your trade. If there is imbalance near the order block, if there is mitigation block above the order block, there is a hierarchy of these things, and we're going to go through them. There is a hierarchy. This is called a price array. Whenever we mention a reference point to price, because this is what it is, this is now a reference point to price. We want to see price trade here. This is our reference point. This is the price level that we're interested in, right? These are called price arrays, right? Every single reference point to price, we call them price arrays. Let's look at Bitcoin, just see if there's any If we can find examples here, oh, this is absolutely disgusting price action. I, I would not trade this, to be honest. You want to see a clear breakout to one side. If you want to see mitigation, this is the last down candle before these trap buys. Very close. If you take the wick of it, it this wick, yeah. Do you see this candle? This wick? Look at that. Very, very, very close, right? You want to this is very wicky. You don't really want to trade something like this. You see, when you have body closes, they're better. When you see large wicks, right? When the wick is longer than the body, I would wait for price to, mature a bit more. You want to avoid the wicky candles. Usually, it's of course is due to price and not price news events occurring, but these aren't favorable to trade really. Um, but that is the mitigation block. One last time to so that you lot can understand what the pattern is. Bearish scenario, you run higher, you retrace and make a low, of course. Then you run higher, failure swing high. Failure swing high just means the next high that you make is lower than this one, so a lower high. The retracement down exceeds the low. Market structure shift here. We respected the high and we attacked the sell stop. Okay, change in the state of delivery. These people are now trapped. Lowest down close candle here because everything after the lowest down close candle is greater. You can't have the lowest down close candle if the next one is lower than it. It's contradiction. Do you see what I'm saying? Comes here, it could come up higher, whatever. It comes here, and we expect it to trade down, trade down, trade down until we reach a logical level of support or your take profit level, which is at a low or imbalance, usually, right? Let me delete this one. For the bullish scenario, it's low, retrace higher. The other low doesn't exceed this low, so it's a failure swing low. You break higher, you free the trap sellers. Mitigation 1 comes down again, mitigation 2, until we find a logical resistance level with a reference point, with a institutional reference point. So this might be an imbalance up here that we want to take profit at, or it might be a high that we ran, take profit. That's what I mean by institutional reference point to a support or a resistance. You could see these patterns happening and forming at institutional support levels. The bearish scenario may happen at an institutional resistance level. Yeah, this model is very powerful. And what does it look like if you're a retail trader? Break and retest. That is why I say the best method if you trade a retail is the break and retest method. It's not that resistance becomes new support or old support becomes new resistance. It's the fact that the algorithm is delivering fair prices to the market, right? It's delivering liquidity and it's delivering price at every single level. Now, institutions that were offside with it, the algorithm will acknowledge that because they're large players, they have the large liquidity. You want the large players with the liquidity to be in the game, right? What's good? What is their liquidity doing if it's offside? There's no good to anyone. So you bring them back into the game. Come up higher. Oh, I don't know what I'm doing. Come up higher again. Same thing happens here until you get to a logical resistance level. That is lesson 1 of chapter 2, mitigation blocks. Find examples of it. It happens on all time frames. Fractal, remember, daily, weekly. Yeah. Adding this onto chapter 1, if you find that you are, so let's say this is daily time frame. You have this, and you break down lower. This is a daily, yeah, and now you've come here, and at this area now here, you're seeing rejection on the daily. So you're here now. You're here on the daily. You see this, you're now rejecting off this mitigation. What's your bias now? Adding this onto the whole thing with bias, yeah, because I told you there was intention behind the way I'm going to teach the syllabus. Adding this onto chapter 1, if you see this on the daily time frame, your reaction of a daily mitigation block. What is going to be your bias after you reject off a mitigation block? Your bias is going to be opposite. It's going to be away from the mitigation, right? So you're going to be bearish here. The next day you expect it to be bearish, or you're going to expect it to trade bearishly at that level, right? That's how you use these reference points. You can use them as entry, and you use them as higher time frame areas of interest. The higher time frame is not for entry. It's for reaction points, interest points. You can have a mitigation block for your reference points on the higher time frame, and then on the lower time frame within the higher time frame mitigation block, you can have the lower time frame entry on a mitigation block. Do you get what I'm saying? It's crazy. This game goes deep. It goes very deep. You can be in a weekly mitigation block, then a daily mitigation block, and then you can find entry within a 15-minute mitigation block, all within that one fractal from the 15 daily weekly. Do you get what I'm saying? Yeah. It's just the low time frames. This is the entry model. For the high time frames, this is your reference point to finding support resistance with quotation marks. So that's the end of the first lesson. Any confusion? Because I know this is new to you guys. You might just thought this is order blocks. No, we're not looking at the up close candles. We're looking at the down close candles, right? Order block is a bit different. Any questions? Ask me, right? Ask me on Snapchat. Collectively, if you need help, there's a new Snapchat group chat. I think CM is the owner of the chat. Do message the discussion if you want to be added to it at him. It's quite good, you know, like people are talking on it. That's what I want you guys to be. I want you guys to be a small community. Um, Being around like-minded people, you can learn from each other, right? If someone is ahead of you, they could help you out. If I'm not there, of course, then come and ask me again so that I know that they taught you well or they taught you the correct thing with the correct in-depth. But yeah, build a small community within you guys. Talk to each other. You don't know who you might meet. It's crazy. It's the world. Life is crazy, and some people I haven't even met in real life. I know them through trading. It, I feel like they're closer than some friends I know in real life. Do you get what I'm saying? Shit's crazy. Anyway, enough waffling. That's the end of the first video. Any questions, hit me up. Take care of yourselves.